Founded in 1990 by gymnastics champion Li-Ning, the brand specializes in developing, designing, manufacturing and operating professional and casual sports shoes, apparel, equipment and accessories. On November 7th, Li-Ning Company Limited's stock price plummeted from 28.45 to 26.15 within 2 days, a cumulative drop of 8%, amounting to a loss of approximately 6.1 billion Hong Kong dollars, or about $7.8 billion US dollars. Surprisingly, the drastic fall in Li-Ning stock was triggered by a few games. On November 5th, during the League of Legends Season 13 World Championship in Busan, South Korea, the Chinese team named LNG was defeated 0-3 by the Korean team T1, leading to their elimination. This defeat sparked outrage among LNG fans who flooded Li-Ning's Douyin live stream with angry comments and calls to boycott Li-Ning products. However, Li-Ning stock has been consistently dropping throughout the year. On October 26, the company's stock plunged over 21% during the Hong Kong stock market opening, closing with a 20.7% drop, and erasing a total market value of 16.5 billion Hong Kong dollars, about 21 billion US dollars. Experts suggest that the sudden decline could be due to Li-Ning's continuously decreasing sales in the third quarter of 2023. Despite not disclosing specific growth details in its operational reports, a broader timeline indicates a pattern to these events. Li-Ning stock decline has been ongoing for about 9 months in 2023. On January 27, 2023, the stock reached a high of 82.7 Hong Kong dollars per share, but has since plummeted, closing most recently at only 24.9 Hong Kong dollars per share, a cumulative drop of 70% and a total loss of 150 billion Hong Kong dollars in market value. This drastic decline has raised questions about what Li-Ning experienced to cause such a significant drop in its stock value. An analysis by a senior researcher at Pangal Institution suggested that the drop might be linked to the company's internal management. In recent years, Li-Ning has been a prominent player in the China chic movement, showcasing at major international fashion weeks, collaborating with top designers and brands, and establishing its design brand, Designed by Li-Ning. Li-Ning was once hailed as a beacon of national brands and acclaimed for its design philosophy. It briefly surged into the high-end market and experienced a moment of glory, but this success was short-lived. Following the Xinjiang Cotton Incident in 2021, human rights organizations sharply criticized the CCP for forced labor in Xinjiang. Western clothing brands like H&M, Nike and Adidas, which joined the boycott of Xinjiang cotton, became targets of boycotts in the Chinese market, severely impacting their sales. At the time, Hong Kong human rights activist Johnson Yearn told Deutsche Welle, "This counteraction is driven by Chinese nationalist sentiment, aided and abetted by China's state media, with the aim of retaliating against international scrutiny of the ongoing genocide in Xinjiang." Consequently, this issue sparked the concept of Made in China. In response, Li-Ning, a Chinese sportswear brand, seized the opportunity to raise prices and position itself as a high-end national sportswear brand. Soon, Li-Ning's pricing soared, with most items priced in the thousands. Notably, the Way of Wade 7 Wow 7 The Moment limited edition sneakers were priced at 29,999 yuan, about $4,100 US dollars, a 17-fold increase from its launch price of 1,699 yuan. Similarly, the Way of Weight for All-Star Silver White sneakers released years ago were repriced at 48,889 yuan, about 6,700 US dollars, a staggering 31-fold increase from the original 1,499 yuan. Consumers lamented that what used to cost a few hundred or 1,000 yuan for a pair of shoes now cost tens of thousands. Under the guise of patriotism, Li-Ning aggressively harvested in the Chinese market. In 2021, Li-Ning saw a massive surge in performance, with revenue reaching 23 billion yuan, up 56.1% year-on-year, and net profits skyrocketing 136.1% to a record 4,000 million yuan. Clothing revenue alone increased by 60.5%, accounting for 52.4% of total revenue, surpassing footwear by 10 percentage points. Analysts noted that Li-Ning's rise was mainly due to its national product's halo and precise timing with the rise of the China chic trend, combined with upscale branding earning a quick profit. However, this moment of glory was fleeting. In 2022, Li-Ning's revenue growth rapidly dropped to 14.31%, and net profits nearly stagnated. By the first half of 2023, the company's revenue growth further slowed to 12.41%, with net profits even dropping by 3.11%. The trend of consumption downgrades hit hard, shattering Li-Ning's high-end strategy. Facing expensive basketball and running shoes, more young consumers expressed, "I can't afford Li-Ning." The current trend sees consumers prioritizing cost-effectiveness and practicality over brand names, leading to Li-Ning being replaced by other Chinese brands like Xtep, 361 Degrees, and Peak Sport products. According to a Caijing report, the average prices of the top 30 best-selling shoes and apparel in various brands' Tmall flagship stores were 199 yuan for Li-Ning, 153 yuan for Antar, 130 yuan for Xtep, and 105 yuan for 361 Degrees. In the current consumption trend, low pricing has seemingly become a unanimous strategy for domestic retailers. Under the backdrop of consumption downgrade, Li-Ning's real brand power might no longer support its high pricing. Although Li-Ning's surge was short-lived, it still reaped many patriotic fans thanks to the China chic trend. However, in 2022, Li-Ning, usually patriotic, faced boycotts from many Chinese citizens over allegations of insulting China due to its clothing designs. At a 2022 product launch, Li-Ning's clothing line, particularly in terms of color and design, was accused of closely resembling Japanese military uniforms, sparking significant controversy online. Chinese netizens vehemently criticized the company, accusing it of reaping benefits in China on the one hand and smearing China on the other. Further fueling the controversy, it was revealed that Li-Ning's registered address is not in China but in the Cayman Islands, known for being a tax haven. Registering in the Cayman Islands enables companies to avoid many taxes and facilitates the creation of a red chip enterprise for listing on the Hong Kong Stock Exchange. Amidst this controversy, leading stock prices plummeted nearly 14% to a low of 50.15 Hong Kong dollars. It later narrowed its losses, temporarily trading at 55.5 Hong Kong dollars, still dropping over 4%. Netizens warned Li-Ning that although it profited handsomely from patriotism, it shouldn't challenge the bottom line of national loyalty. On the other hand, analysts point out that Li-Ning's decline is linked to lowered market expectations for the company's future performance, as well as declining sales and competitive pressures in the market. For example, Li-Ning's biggest problem, unsold inventory, appears unresolved. Financial reports reveal that as of the first half of 2023, Li-Ning's inventory amounted to a staggering 2.1 billion yuan. Consequently, the brand had to lower its profile and initiate extensive price reduction waves since last year. Throughout this year, Li-Ning has periodically launched promotions like additional 40% off and more than 30% off during major holidays, each wave offering deeper discounts. However, these massive discount promotions have led to significant discrepancies between online and offline prices, causing strong consumer dissatisfaction. On Xiaohongshu, China's social media platform, searching for Li-Ning yields numerous complaints from consumers about the lack of a price protection mechanism. The consumer service platform Black Cat reflects similar grievances, with half of the recent complaints targeting the issue of Li-Ning's failure to guarantee price protection. Industry insiders note that the overall inventory level of domestic sports brands remains high, posing risk. Consumers have become more price sensitive and less enthusiastic, putting Li-Ning, whose average price is higher than its competitors, under greater inventory pressure. Li-Ning is likely to continue offering product discounts to clear inventory. While discounting to clear inventory has helped Li-Ning address its stockpile issue, the associated pains have also become evident. According to the Zhong report, Li-Ning's gross profit margin dropped from 55.89% in the first half of 2021 to 48.78% in the first half of 2023. The report attributes this decline to increased discounts in online channels and retail outlets, direct-to-consumer marketing, including e-commerce and direct-operated stores, and a 34.4% year-on-year increase in inventory to 143 million yuan. A distributor revealed that to increase sales and quickly reduce inventory, they resorted to slashing prices, further compressed by platform commissions and other channel expenses. This has resulted in very low profit margins for each pair of Li-Ning shoes. Analysts point out that to maintain a healthy inventory, sportswear companies often intensify their inventory clearance efforts, leading to deeper discounts and larger price reductions, likely causing further declines in gross margins. Industry insiders note that Li-Ning's development strategy in the past 2 years has not fundamentally changed, failing to keep pace with the changing preferences of consumers, leading to sluggish sales growth. Moreover, Li-Ning faces competition from brands like Anta, which is moving upmarket, and Adidas and Nike, which is extending downwards. This competitive landscape is squeezing Li-Ning's market space. Faced with a catastrophic stock price plunge, Li-Ning had to urgently announce a buyback, which means repurchasing its shares from the market. According to announcements, the latest buyback involved an amount of 28.97 million Hong Kong dollars, repurchasing approximately 1.2 million shares. This marks the fourth buyback in just over a month. Notably, Li-Ning's management downgraded its 2023 sales growth guidance to below 10%, from the previous 15%. Given these warning signs, several foreign institutions have downgraded their target price for Li-Ning stock. For instance, JP Morgan Chase & Company reduced its earning forecast for Li-Ning for the next 2 years by 5 to 10%, setting a new target price of 56.4 Hong Kong dollars. Similarly, Dawei Securities Group Incorporated downgraded its investment rating from buy to hold, anticipating Li-Ning's ongoing struggles with macroeconomic factors and internal adjustments, lowering its target price from 55 to 49 Hong Kong dollars. Citibank also adjusted its earning forecast for Li-Ning for 2023 to 2024 by 3% and 10% respectively, and slashed its target price from 62.7 to 45.1 Hong Kong dollars. Morgan Stanley even indicated in its latest report that it would lower its sales and profit forecast for Li-Ning for the next 3 years, reducing its sale forecast by 6%, 11% and 13% respectively, and profit forecast by 17%, 17% and 16% respectively for 2023 to 2025. The stock target price refers to where investors predict a stock will reach based on its trends, financial data, and other factors. Continuous downgrades imply numerous bearish signals for the company, indicating a worrying future. Clearly, Li-Ning is currently facing such challenges. Experts believe that for the company's future, Li-Ning needs to strengthen its brand building and product innovation to meet changing consumer demands. Additionally, Li-Ning should enhance internal management, improve efficiency, and reduce costs. If the company can implement effective measures, it might still find its place in the fiercely competitive market. However, the competition in China's sportswear market is only expected to intensify, and Li-Ning's prospects for significant short-term progress remain uncertain.